crash course on mastering the essentials of investing, all in about 10 minutes. Welcome to our quick guide on mastering investing in just 10 minutes. Whether you're just starting out, confused about where to put your money, or you're already playing the market but want to step up your game, these 12 steps are like the cheat codes to leveling up your financial future. We're going to break down intimidating jargon into bite-sized pieces, cover the strategies that actually matter, and by the end of this video, you'll be well on your way to making your money work for you. So grab your notebooks, let's dive in and get you on the road to financial freedom. Before you even think about throwing money into the stock market or buying that rental property everyone's talking about, we need to take a step back and talk about you. What are you actually trying to achieve with your investments? Are you dreaming of retiring early, traveling the world, buying your dream home, or maybe just having enough to cover those unexpected life expenses? Having a crystal clear vision of your financial goals will be the compass that guides all your investment decisions. Think of it like this. If you don't know where you're going, any road will take you there, right? But when you have a destination in mind, you can map out the most efficient route. That's what defining your financial goals does for your investments. Write those goals down, make them specific, and keep them front and center as we continue this journey. Now that you've got your financial compass set, it's time to explore the vast world of investment options out there. Don't worry, you don't need to become a Wall Street whiz overnight. We're just going to cover the basics. First up, we've got stocks. Think of these as little pieces of ownership in publicly traded companies. When you buy a stock, you're essentially buying a tiny slice of that company. If the company does well, the value of your stock goes up, and you make money. Of course, the opposite is also true. Next, we have bonds. These are like loans you're giving to governments or corporations. They promise to pay you back the loan amount plus interest over a set period. Let's talk about risk. Investing always involves some level of risk, and it's crucial to understand your own risk tolerance before you put your hard-earned money on the line. Simply put, risk tolerance is how comfortable you are with the possibility of losing money on your investments. Are you someone who thrives on adrenaline and doesn't mind taking big swings even if it means potential losses? Or do you prefer to play it safe and prioritize preserving your capital, even if it means potentially lower returns? There's no right or wrong answer here. Remember, it's better to sleep well at night knowing your investments align with your comfort level. Chapter 4. Step 4. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. Well, in the world of investing, that's not just a saying, it's the golden rule diversification. Diversification is all about spreading your investments across different asset classes, industries, and geographical regions. The idea is to reduce your overall risk. Think about it. If all your money is invested in a single stock and that company goes belly up, you could lose everything. But if you've diversified your portfolio, even if one investment performs poorly, the others can potentially offset those losses. Remember, diversification is your best friend when it comes to managing risk in your investment portfolio. Now, I know all this talk about different investment options can feel overwhelming, especially if you're just starting out. So let's talk about a simple yet incredibly effective way to get started. Index funds. Index funds are like the autopilot of the investing world. They're mutual funds, or ETFs, that passively track a specific market index like the S&P 500. Instead of trying to beat the market, which even professional investors struggle with, index funds aim to match the market's performance. The beauty of index funds is that they're low cost, diversified, and require minimal effort on your part. Just invest consistently in a broad market index fund, and you'll be well on your way to building long-term wealth. Chapter 6. Step 6. Review and rebalance, keeping your portfolio on track. Remember that diversified portfolio we talked about? Well, it's not a set it and forget it kind of deal. Over time, as your investments perform differently, your portfolio can drift away from your original asset allocation. That's where portfolio review and rebalancing come in. Regularly reviewing your investments and making adjustments to maintain your desired asset allocation helps keep your portfolio on track to meet your financial goals. Now, How often you rebalance depends on your risk tolerance and how much your portfolio has drifted. Some investors prefer to rebalance annually, while others might do it quarterly or even monthly. The key is to find a rebalancing schedule that works for you and stick to it. Chapter 7. Step 7. The Emergency Fund, your financial safety net. Before we get too deep into the world of long-term investing, let's take a step back and talk about something crucial: your emergency fund. This is non-negotiable, people. Think of it as your financial safety net, there to catch you if, or let's be real, when, life throws you a curveball. Ideally, your emergency fund should have 3 to 6 months worth of living expenses. Your emergency fund needs to be accessible when you need it, so keep it in a safe and liquid account, like a high-yield savings account or a money market account. Chapter 8. Step 8. Fee awareness. Don't let fees eat your returns. Here's a hard truth about investing. Fees are sneaky. They often hide in plain sight, slowly chipping away at your returns over time. But the good news is that by being aware of fees and making smart choices, you can keep more of your hard-earned money working for you. One of the biggest culprits is expense ratios charged by mutual funds and ETFs. These are annual fees you pay to cover the fund's operating costs. While they might seem small, even a difference of a few percentage points can make a significant impact on your returns over the long haul. By understanding the different types of fees, comparing costs, and choosing low-fee options whenever possible, you can significantly boost your investment returns over time. Chapter 9. Step 9. Stay informed. Knowledge is power in investing. The world of investing is constantly evolving. New trends emerge, markets fluctuate, and staying informed is crucial to making informed decisions about your money. Start by following reputable financial news sources. Read books, listen to podcasts, and follow industry experts on social media. The more you understand about the markets, economic trends, and the factors that can influence your investments, the better equipped you'll be to navigate the ups and downs and make sound financial decisions. Chapter 10. Step 10. Patience. It's a marathon, not a sprint. If there's one piece of advice I could give every investor, it's this: be patient. Investing is a long game. It's about slow and steady growth, not overnight riches. Trying to time the market, chase short-term gains, or make impulsive decisions based on emotions is a recipe for disaster. Think of investing like planting a tree. You don't expect to see a towering tree overnight, do you? It takes time, patience, and consistency for that tree to grow strong and tall. By investing consistently, staying the course even when the market gets bumpy, and focusing on the long term, you give your investments the time they need to compound and grow. Chapter 11. Step 11. Automate your investments. Consistency is key. We live in a world of instant gratification. We want everything now and we want it fast. But when it comes to investing, slow and steady wins the race. And one of the best ways to stay consistent with your investments is to automate the process. Automating your investments takes the emotion out of the equation and ensures you're consistently investing, regardless of market conditions or how you're feeling that day. Chapter 12. Step 12. Seek professional advice. When in doubt, ask an expert. Navigating the world of investing can feel overwhelming, especially if you're new to the game or dealing with complex financial situations. And while there's a wealth of information available online, sometimes nothing beats getting personalized advice from a qualified financial advisor. Think of a financial advisor as a financial coach. They can help you create a personalized financial plan, choose investments that align with your goals and risk tolerance, and answer any questions you might have along the way. Remember, seeking professional advice doesn't mean giving up control of your finances. It's about having an expert in your corner to guide you, answer your questions, and help you make informed decisions about your money. And there you have it. 12 essential steps to master investing in just 10 minutes. Remember, the key to successful investing is staying informed and being patient. Don't get caught up in the hype or try to time the market. Focus on the long term, make smart choices, and your future self will thank you. If you found this guide helpful, don't forget to like, subscribe, and share it with others who might benefit. Let's spread the knowledge and empower more people to take control of their financial futures. Happy investing!